My name is Andrew Mazzone. I'm the president of the Henry George School of Social Science. This is the second lesson of 4 on depression in a credit-driven economy. We're doing this course in conjunction with Richard Duncan's economic organization. He wrote the book, The New Great Depression. Thanks.
Throughout most of the 20th century, there were 2 important constraints on the amount of credit that could be created in the United States. The first was the legal requirement that the Federal Reserve hold gold to back the paper currency it issued. The second was the legal requirement that commercial banks hold liquidity reserves to back their deposits. In this lecture, we'll see how these constraints were removed, allowing credit to expand by an extent that earlier generations of economists would have found inconceivable. Total credit in the United States first exceeded $1 trillion for the first time in 1964. Over the following 43 years, it expanded 50 times to $50 trillion. That explosion of credit completely transformed the global economy. In this lecture, we're going to discuss how it was that credit slipped its leash. Now, first of all, let me explain what I mean by total credit. Credit and debt are 2 sides of the same coin. So one person's credit is another person's debt. So what I mean by total credit is all types of debt in the United States. Government debt, household sector debt, corporate debt, financial sector debt, all the debt combined. Now this explosion of credit was something completely unnatural, and it occurred because of 3 developments. First, it came about because the Federal Reserve stopped backing dollars with gold. Second, the liquidity reserve ratio of the banking system was slashed. And finally, central banks outside the United States began creating enormous amounts of fiat money and accumulating dollar reserves and investing those reserves into the United States, into US dollar assets. First, you can see in this chart that what happened after the Fed stopped backing dollars with gold in 1968. Up until then, it had been a law. There had been a law that the Fed had to maintain gold backing for every dollar that it issued. That law was changed in 1968. Afterwards, the Fed no longer had to maintain any gold backing whatsoever. Afterwards, the Fed was able to print another 1 trillion paper dollars, creating roughly 23 times as many dollars as had existed up until that time. And that creation of 1 trillion new paper dollars acted as the foundation upon which the $50 trillion of credit could be created. Had the dollars continued to be backed by gold, it wouldn't have been possible for the Fed to create 1 trillion new dollars, and therefore it wouldn't have been possible for $50 trillion of credit to come into existence. The second change relates to the liquidity reserve ratio of the banking system. Commercial banks create deposits and credit through the system known as fractional reserve banking. And the liquidity reserve requirement determines how much. The money multiplier determines the amount of deposits the banking system can actually create. The money multiplier is equal to 1 divided by the liquidity reserve ratio. Now in this table, we can see how banks create deposits through the system of fractional reserve banking. Here, we're assuming that the liquidity reserve ratio is 20%, and we're beginning with an initial deposit of $100. So in round 1, $100 is deposited into the banking system. Because the reserve ratio is 20%, the banks have to set aside $20, and the bank can lend out the remaining $80. So whoever they lend the money to, eventually, that person deposits the money back into the banking system. And that starts round two. $80 is deposited. $16 has to be set aside as the liquidity reserve. And $64 can be lent out again. That leads to round three. $64 is deposited. $13 or 20% is set aside as the liquidity reserve. And $51 is lent out. And this occurs again and again until ultimately, after more than 30 rounds, we end up with $500 of deposits, $100 of reserves, and a total of $400 of credit. So we began with $100 of deposits, but now we end up with $500 of deposits. That's because the money multiplier is 1 divided by the liquidity ratio. The liquidity ratio here is 20%, so 1 divided by 20% is 5. That means that the money multiplier 5 times the initial deposit of 100 results in the end in $500 of deposits. That's how the banking system creates deposits and credit through the system of fractional reserve banking. Well, the thing that changed is that the Fed steadily lowered the liquidity reserve ratio. And the banks also started taking in more time deposits rather than demand deposits. And time deposits had a lower liquidity reserve ratio requirement. Banks also raised more funds from the bond market, and those funds required no liquidity reserve ratio whatsoever. So the liquidity reserve ratio as a percent of total bank liabilities moved lower and lower toward zero, and thus the money multiplier moved toward infinity. You can see that in this chart. The effective liquidity reserve ratio at the end of 1945 was roughly 13%. But by 2007, it had moved down to 1%. Consequently, the money multiplier moved toward infinity, allowing the commercial banking system to create more and more credit through fractional reserve banking. The third thing that changed was that other central banks outside the United States began creating enormous amounts of fiat money too. After the Bretton Woods system broke down, many countries began manipulating their currencies by printing money and buying foreign exchange. Total foreign exchange reserves increased from $95 billion in 1971 to almost $7 trillion in 2007. Of that amount, roughly 75% of all reserves were dollars. In other words, there were $5 trillion of foreign exchange reserves. That $5 trillion was invested into US dollar-denominated assets, and that financed roughly 10% of all the credit in 2007, the $50 trillion of credit. 10% of that was financed by the investment of foreign exchange reserves by central banks outside the United States. Here you can see the chart of foreign exchange reserves. So credit exploded due to fiat money creation by the Fed, credit creation by the banking system, fiat money creation by other central banks outside the US. This all led to a 50-fold expansion of credit in just 43 years. Nothing like that had ever occurred in history. And that explosion of credit completely transformed the global economy and created the world we live in. In the next lecture, we're going to see how this $50 trillion expansion of credit in just 4 decades transformed the US economy. For more details on how it was possible for total credit in the United States to expand 50 times in just 43 years, please see the first 2 chapters of my most recent book, The New Depression, The Breakdown of the Paper Money Economy. Total credit in the United States expanded from $1 trillion in 1964 to $50 trillion in 2007. That 50-fold increase in credit brought unprecedented prosperity by increasing wealth, profits, jobs, and tax revenues. It also fundamentally transformed the structure of the economy and even the nature of the economic system itself. In this lecture, we'll consider the impact that $50 trillion of credit had on America. Total credit in America expanded from $1 trillion in 1964 to $50 trillion in 2007. So let's take a look at who borrowed the money. Between 1987 and 2007, the financial sector increased its debt from $2 trillion to $16 trillion, a 750% increase. The household sector increased its debt from $3 trillion to $14 trillion. That's a nearly 400% increase. The corporate sector increased its debt from $2 trillion to $7 trillion, a 230% increase. And the federal government increased its debt from $2 trillion to $5 trillion, a 160% increase. This chart shows the ratio of total credit to GDP going back to 1946. Now notice for a long time it was around 150%. But then in the early 1980s, President Reagan cut taxes and sharply increased military spending, and that resulted in a very large budget deficit equal to 5% of GDP for 5 years in a row. That increase in government debt caused this ratio to jump to 230%. It then flattened out for a little while, but due to the increase in household sector debt and the debt of Fannie Mae and Freddie Mac, it later reaccelerated and rose all the way to 350% of GDP. Now, as long as credit is expanding rapidly, it's very easy to understand how rapid credit growth drives economic growth. As long as credit is expanding rapidly, the consumers have more access to credit, so they borrow more and they spend more. And the more they spend, the more profitable businesses become. So businesses hire more workers, they expand their capacity, and they even pay more taxes. So the government has more money to spend. And all the while, asset prices keep inflating upward, creating an upward. So as credit expands, it creates an upward spiral of increasing prosperity. The problem is the day always arrives when credit can't expand any further. And at that point, the upward spiral goes into reverse. And that's what happened in the United States in 2008. So this chart, you can see that as credit expanded, so did household sector net worth. In other words, the credit creates the wealth. The Dow Jones Industrial Average rose from 1,000 in 1982 to 14,000 in 2007. The median price for a home in the United States jumped from $64,000 in 1980 to $260,000 in 2007. Profits doubled between 1999 and 2007, both for the non-financial sector and for the financial sector. Finally, tax revenues surged, both at the federal level and at the state and local level. But the economy wasn't just larger, it was fundamentally different. Between 1947 and 2007, as a percentage of GDP, the manufacturing sector shrank from 26% of GDP to 12%, while the finance, insurance, real estate, and rental and leasing grew from 11% of GDP to 21%. Also, professional and business services jumped from 3% to 12%. So in other words, the US economy was transformed from being one based on manufacturing to one based on providing services. And that's what you can see in this chart. The next chart shows the national net savings rate. It declined from 12% in 1950 to less than 2% in 2007. That's because on a net basis, a country can't borrow and save at the same time. This chart shows the ratio of GDP to total credit, and you can see it's been declining. What that tells us is that the return on credit has been falling. In other words, for each unit of credit growth, it generates a smaller unit of economic growth. And finally, this explosion of credit has transformed the very nature of the economic system itself. Capitalism has evolved into something different. I call it creditism. Under capitalism, the economic growth dynamic worked like this. Businessmen would invest, some of them would make a profit, they would save that profit, or in other words, accumulate capital, hence capitalism, and repeat the process. Economic growth was driven by investment and savings. It was slow and difficult, but that's how capitalism worked. Our economic system hasn't worked that way now for decades. The growth dynamic under our economic system has been driven by credit creation and consumption, and more credit creation and more consumption. And that has generated very, very rapid economic growth. The problem is, it now looks like this new economic system, creditism, has hit the full potential to create any more economic growth, because as of 2008, the private sector couldn't bear any more debt. And at that point, the global economic crisis started. So there's a limit as to how much debt any economy can bear. And that limit's determined by the economy's ability to generate sufficient income for the people, sufficient income to service the interest on the debt. In 2008, the United States hit that limit. And when the private sector started defaulting on its debt, then creditism began to spiral into a new Great Depression. During the 1950s and 60s, the Fed had tight control over US interest rates, credit creation, and the economy. But by the turn of the century, it had lost control over all those areas, plus the US balance of payments and the value of the dollar. Financial product innovation and industry deregulation circumvented and then completely destroyed all the New Deal laws that had been enacted to ensure sound banking. The disaster of 2008 was the result. In this lecture, we'll take a look at one of the worst US policy mistakes during the last 40 years, financial sector deregulation. Beginning in the 1950s, a large pool of unregulated dollar liquidity began to accumulate as deposits in London, in banks not subject to US laws requiring liquidity reserves or interest rate ceilings. By the late 1960s, this euro-dollar market began to make it difficult for the Fed to slow down the economy by hiking interest rates to make credit scarce. Corporations could simply borrow in London at interest rates that the Fed couldn't control. Soon, short-term capital flows originating in this euro-dollar market soon began to destabilize the currency markets. Then, rising inflation forced the public to begin to look for higher interest rates than those offered on bank deposits, which were capped by law. Depositors shifted their money from bank deposits into mutual funds, which offered higher returns. This outflow of deposits from banks forced the Fed to allow banks to attract funds by selling certificates of deposit. By significantly broadening banks' funding sources, this change made it more difficult for the Fed to constrain bank lending by controlling the cost and availability of deposits. Next, banks began to bundle loans together, split them into tranches with different degrees of risk, and sell them to outside investors. This process became known as securitization. Securitization allowed the banks to earn origination fees and servicing fees. It also freed them from credit risk and the need to maintain regulatory capital. Mortgages, credit card receivables, car loans, and student loans were all securitized. But lending standards suffered since the bank originators were not on the hook for the credit quality. Then during the 1980s, the New Deal banking regulation began to be rolled back. Congress removed the ceiling on bank deposit rates during the early 1980s. Glass-Steagall was repealed in 1999, and derivatives were deregulated in 2000. During the 1990s, the laws barring commercial banks from the underwriting business had gradually been whittled away. The Financial Services Modernization Act of 1999 repealed what was left of Glass-Steagall. Travelers, a very large insurance company, had already acquired Solomon Smith Barney, an investment bank, and merged with Citicorp, a commercial bank. This was a pernicious violation of the spirit of the law. So after 60 years, banks were once again brokers, and brokers were once again bankers. The Commodities Exchange Act of 1936 required that all futures and commodity options be regulated and traded on organized exchanges. But the Commodity Futures Modernization Act of 2000 undid that law. It permitted over-the-counter trading and left derivatives largely unregulated. Afterwards, the number of derivatives contracts trading over the counter exploded. By 2008, there were $700 trillion worth of over-the-counter derivatives contracts. $700 trillion is the equivalent to $100,000 per person on Earth, or it's equal to the value of everything produced on Earth during the last 20 years combined. Now, only 10% of derivatives are now traded through exchanges. We know that their average daily turnover is something like $4 trillion a day. The average daily turnover of the 90% trading over the counter is not known. But if they trade on the same scale as those that trade through exchanges, then their average daily turnover could be something like $40 trillion a day. That's equivalent roughly to 75% of the value of everything created on Earth during a full year. Here you can see the derivatives exposure of the three largest U.S. banks at the end of 2010. JP Morgan Chase had $79 trillion of derivatives exposure, Bank of America $68 trillion, and Citigroup $47 trillion. Combined, that amounts to $195 trillion of derivatives exposure, and that's roughly equal to 3 times global GDP. Finally, as time went by, the financial industry got up to an increasing number of accounting shenanigans. Banks set up off-balance sheet special purpose vehicles that allowed them to hide risky assets and reduce their capital requirements. The investment banks used extremely high levels of leverage, from 26 times to 33 times their capital. A fragmented regulatory regime allowed all financial institutions to employ regulatory arbitrage. And numerous accounting scandals involving derivatives have occurred, including those at Enron, Fannie Mae and Freddie Mac, and General Electric. At the end of 2010, the 4 largest U.S. banks held 35% of all deposits in the United States, the highest concentration of deposits in U.S. history. So why weren't these banks broken apart at the end of 2008? Well, there's a very real possibility that the banks are simply too bankrupt to break apart. Due to their derivatives exposure, it's not inconceivable that the sum of their parts is a multi-trillion-dollar negative number. Today, this industry remains inadequately regulated. Dodd-Frank, the financial sector reform bill passed in 2010, required that most derivatives trade through exchanges by mid-2011. That still hasn't occurred, and it's not certain when it will occur. Until derivatives are forced to trade through exchanges, they're going to remain an unregulated can of worms with next to no transparency. As long as that's the case, the derivatives market will continue to be a grave threat to the stability of the global economy.
How long can credit creation continue?
That's a great question. How long can credit creation continue? Well, there's some examples of credit creation much greater than ours in existence right now, like Japan. Japan has created a lot more credit relative to its GNP than we have. But then Japan has a country that exports lots of products and has money coming in from its exports. The United States does not have an export surplus. It has a negative, it has a deficit on its export account because it buys more than it sells. And it finances that by printing more money. The Japanese print more money to float their budgets, but not to pay for products that they buy, because they sell more to other people than they buy from other people. But the United States has a lot of power. The United States forces the world to buy oil using American dollars. Now, oil is the key resource on the planet. And the United States, one way or another, controls the flows and the delivery of the oil to North America, South America, Africa, most of Asia, not to Russia, and maybe not completely to China, which has great coal reserves, but enough so that if you pay for it in American dollars, the American dollar will always have some value. It can't be inflated like crazy or printed like crazy to zero, because the oil prices will just go up and carry value on the dollar for a long time to come. But how long can that go? Well, right now it's going a long time because the Federal Reserve, or the main bank in the world, in the United States, has lowered interest rates to practically zero. So everybody who has a debt and credit card and everything like that is not paying the full maximum amount of interest rate that they would pay if interest rates were higher, although they still pay high credit card rates. But corporations, governments, and people like that don't pay a difficult interest rate, a high interest rate, because the government has kept them low. But again, they can only do that for so long, because if that weren't the case, everybody would just print money and be done with it. No one would have to work, just print money and spend that money. So obviously you can't print money and outrace the amount of products made in the world by too great a factor. And what is that factor? Well, in 2008, we couldn't do it anymore, and things had to stop and collapse so that it had breathing room, and we built it back up and running it out again. So at some point in time, when the debt to GNP ratio starts to approach what it did in 2008, that's probably the signal that we're close on not to be able to continue to print more money. But I think as a practical rule, and it's hard to guess this, I would think we have a few more years of credit printing before the thing becomes unstoppably perverse and blows sky high. But if you're a banker, a stockbroker, and you live in New York and things are good, every year is precious. So if the government is going to blow you up 4 years down the road, that's better than blowing you up today. So I think, and he alludes to it, the government would rather kick the problem down the road and hope somehow we'll muddle through. But it's an excellent question. We can't do it in unlimited fashion, because if that were true, why doesn't the government just print money every day, hand it out to people, and they can use it to buy things? Obviously, and the people who had that money could go buy products and raw materials to make things to sell you. So that would seem to be just a wonderful way to do it. But somewhere in that system, someone won't take American dollars that are in effect are becoming worthless, because there's so many of them around. And at some point, the system would blow up and unravel. But no one has ever been able to predict the exact point. Although there were a number of people who predicted 2008. That happened to be a completely berserk case of wild speculation and credit creation.
In terms of the deregulation and the last 50 years from 1 trillion to 50 trillion, there's no money, or the banks are typically obviously buying off the banks and controlling the markets. So there's no sign really of this slowing down. You're saying it might last a few more years, but it's already controlled. Although there's people like yourself, like economists, or those that caught or speculated that might exhaust in 2008, it still rode out its wave, so to speak. So
what you're saying is, you from your perspective, it seems to be okay and it's going on again. But I'll point out in 2008, there was tremendous debt deflation and people took tremendous losses. So the system is not valued as much today as it was back then. So there's room to blow it back up to at least back to 2008 and a little beyond, in my opinion. So there's, because keep in mind, a tremendous amount of wealth was destroyed. And if the wealth's destroyed and it's not there on the books, it's a zero. Well, then you can inflate again because you haven't got a high asset base, you got a destroyed asset base. But at some point in time, you've got to have purchasing power pretty well in the hands of people all over the world to justify a productive economy, so the people have money to buy and sell. What you have here is this money inflation is only increasing financial assets, not productive assets. You know, and everything else is just bumping along at a very reduced level, and you have tremendous poverty because of that. You know, more Americans, probably half of Americans today can't get a job to suit them. So the compression appears on the lower half of the population distribution. It doesn't appear in New York at the elite level. This is the high end of it. It's where all the money came. And there's no mechanism to distribute money now to the lower ends of that population spectrum. And so at some point, this thing will wind up and blow itself up again. But if it does, and they can bail it out again somehow, well, they'll keep running like this, because there's no one complaining or really revolting. People don't like it, but you don't see any rioting in the streets over it, really. People just have accepted what's going on, and even if their job prospects have been diminished in America over the last 20 or 30 years, they figure they can muddle through. You know, somehow that they can invent an app on a handheld telephone and somehow score. You know, the newspapers are filled with all these success stories, which are only a small part of the population. But if you read about them all the time, you kind of think like, why aren't you doing an app or something like that? So by all traditional means in analysis, we're in very serious trouble. But they understand how to buy time. You know, they just understand how to patch this, feed people. As long as they keep feeding people, people will tolerate almost anything. Look at Haiti. Hate to pick on that poor country, but somehow I think they're feeding everybody in Haiti, and although Haiti has no wealth, you're not reading about revolution in Haiti. Now, you do read it in the Mideast, but the Mideast is very close to all the oil, which is the real main driver of the Industrial Revolution and progress and wealth. And they see close hand that they do have wealth there, but it's not coming to them, and so you got the Mideast is kind of churning. But in Haiti, they don't see any oil, they don't see any wealth. Therefore, for Haitian, he's happy to be alive with no greater expectation. I don't want to be unfair to Haitians, because many Haitians in New York are hardworking people and do very well when they come to an environment where they have a chance. But my point is only that it's hard to have a revolution today, and highly unlikely. With most people, if they get to eat somehow, are happy, and also the apparatus to suppress revolutions is very robust, so they can really pick off any revolutionary sentiment very quickly. So this is what you have. Go ahead.
My question is going to be about inflation. We know that when there is credit expansion, sooner or later we should expect prices to go up. Now, what happened during the last decade, we realized that what happened, we had an expansion of credit. I think he gave the numbers from 1 to 50, and yet we still do not have inflation.
That's the great puzzle of the last few years. Why didn't inflation show up all across the product spectrum and the economy? And obviously it didn't. Well, first of all, usually inflation, although they say it's a money phenomenon, it's also a bottleneck phenomenon. If you all want the same products and you can't produce them, well, you're going to get inflation whether there's an increased money supply or not. If there's no increased money supply and you can't get what you want, people will be chasing fewer products. But the big reason why we didn't have a general inflation in this period is because we introduced China into our marketplace that essentially made all the things that we needed, and they were willing to make them very cheaply because they had the cheap labor. And their main objective in the first 50 years of their expansion was to get the machinery and technology and know-how so they could truly become manufacturers of the world, which they weren't before. So they were willing, in effect, to not take all the money they could get off the table, just wanted to sell everything they could do and get everything they could get in terms of machinery. So that put a lid on products. So that excess money became available to fuel asset speculation. In other words, a person looks around and he says, I can get anything cheap that I need for my daily needs, but one of the big things I need is to get a business or a set of assets that will make me a lot of money so I won't have to work. And of course, if he gets extra money because of the inflation of credit, and he goes and buys real estate, he's been told real estate your best investment, stock market is always good. They start flooding into that. It becomes a self-fulfilling prophecy because there's lots of money being created. That 50 trillion is heading to assets. It's suppressed at the product level because of China and cheap labor and free trade and so forth. If it wasn't free trade and they didn't come in, that asset inflation would have been all across the board. So, but the asset inflation allowed very wealthy people to really make claims on wealth. And they're able to use that to buy not only real estate, but industrial companies and invest overseas. And that accounted for the great perverse distribution of income being so out of whack. And of course, when you do that, then the people who spend the money don't have the money. They can't buy anything. They can buy less and less. They've lost their jobs. They got credit to continue to buy from China. Now they have no credit. They have to not buy so much from China, and China suffers. And all the excess money goes to the assets. And the guys who are in the asset markets are hoping when things go bad, they can sell at the top, take that money and go buy real assets like farmland, hideaways in New Zealand, anything, buy gold and bury it in the ground so that when the blow comes, they have something real to start over with when it comes apart, and which it will come apart. But that's a good question, because everyone would have expected inflation. And also another thing that kept interest rates down is the Chinese, as they sold to us and got American dollars, in effect round-tripped those American dollars back to America and bought government debt, which made the government debt rise and the interest rates fall. And of course, the interest rates fall, you could issue more credit, like the 50 trillion that you're talking about there. So it was a virtuous circle for one country trying to get in a position, China, for another. Now you say, well, isn't that bad for the United States, that China is going to ultimately end up maybe running everything? And the answer would be, I think the smart people in this country, whether it was going to happen or not, because in my mind it's an open question whether it would have happened, but if China and Asia was going to be the wave of the future, a New Yorker who's a banker and a stockbroker would look at that as just another investment opportunity. He invests in China. He doesn't care if it's in America or China. His money is made on the asset side of buying and selling and financing. So if America is going to sell out and go to China, and it allows the game to go on for another 20 or 30 years during the transition, and he's part of the China game, it's no skin off his teeth if America fails, because he doesn't consider himself an American anyway. He's a New Yorker who's very wealthy. He's an international citizen, and his friends are worldwide citizens. You know, he hangs around with different circles, and those people believe they can run the world and sell to themselves. They're a big enough market, and they can make what they need by China and automation, that they simply don't need 280 million Americans who are not necessarily economically, but are going to be required to be fed and housed and clothed. And in a hedge fund or investment banker's point of view, they contribute nothing other than they take. They don't produce anything. So it's a very dangerous situation when you start thinking of people as not being of any value. Because at the end of the day, whether they have no value or not, they certainly will know how to kill you in a showdown. They give their life up for yours, and they say, if my life is worthless, I'll take your so-called worthwhile life out. You got more to lose than me. And in that case, the person with the wealth loses. So, but again, we're in a situation where it's what I call the Goldman Sachs syndrome. And again, I don't mean to pick on Goldman Sachs here. It could be an investment banking or financial syndrome. We find ourselves at the head of the class with this. And people at this level in finance are making a lot of money because, in effect, everyone has to gamble in the financial markets, hope that they can get lucky to get a piece of that action so they won't be trapped on the lower end. So these guys get first whack at that capital. Their lives are good, and even if the planet blows up environmentally down the road, they don't believe anything can be done about it now. They probably think it's too late. So they're just going to keep status quo, keep the gas pedal down, and just go as long as they can until it's over. And who's to blame them? You probably would do the same thing, you know? Although you can't run a world and a country that way long term.
So obviously, we are in a situation of crisis. Now, if we were to reconstruct the economy on the basis of George's principles, in your opinion, where would we start?
I'll preface this question by saying the following. That as a fundamental, irreducible principle on this planet, all lives are equally valuable. In other words, if you're a human being and you're born on this planet, regardless of your circumstances, your color, your class, your situation in life, where you're born, if you start making those distinctions important, then there can never be an end to wars on this planet with one group or another always at each other's throats saying, well, I'm worth more than you, therefore on a planet where it's becoming diminishing, I have more right to resources than you do. If you do that, then you're in trouble, and it will end sooner or later when resources do start to run out to the point where everyone can't have what they want consistent with the standard of living and technology that exists at the time. And this technology now is at a much higher level than it was 100 years ago. So first of all, you'd have to have that recognition. Second of all, as a Georgist, I would immediately impose a tax on nature, land, resources, all of those things that have been occupied for private gain would have to go, as I would prefer to do it, as a citizen's dividend. That money goes to everybody on the planet or everybody in the country in an equal basis for being a citizen of that country. And that it doesn't go to a few hands, because if I can own the assets of a country, I can own the real estate. I can go to a bank and borrow against that because it's a powerful asset. It's got great collateral, and I can borrow against it and buy more and more of it until finally you have no chance to live at all on the planet. So you have to break that monopoly on nature up. Now, if you do that, most of the problems you see would start to diminish. You'd have incomes would start to go back to based on just your relative ability, and the difference between a smart person and a not so smart person is not that great to create that kind of disparity of wealth that you see today. So that you would have a much more harmonious situation if you did that. The problem with that ultimately in the end is we're close on to a situation in this planet where we're constrained by natural resources. We're fouling the nest anyway. And even if we built a wonderful and fair economy, we still have to deal with this issue, which is impending on us all. Let's say we make a fair society, it still doesn't solve a society in harm's way environmentally. So the second big challenge would have to be to reverse the bad effects of industrialization, which is essentially the spewing of carbon into the atmosphere and the oceans. And so we'd have to go to renewable energy, sunlight, wind, and so forth. Use all our might to do that, rather than just burning more fuel, kerosene, and coal. But the odds of two of those solutions being implemented are very low, I think. And it's because for the people who have it now, they look around and say, boy, we get that, but that's a tall order. And if I join up with that kind of a program and I get pushed down to the bottom, no one's going to take care of me necessarily, and I could be hurting. Whereas I got a sure thing now for as long as it goes. And everybody will take the next day, the next day, the next day, rather than say, no, I'll play for a long-term uncertain future. So that's the real problem that humanity has. Even if you know there's a way out, and all the smart guys know, you go talk to the hedge funds guys, I'm sure they know what I've just said. And you say to them, okay, well then why don't you be part of the solution? And so they said, well, I can't be guaranteed that I'll survive the solution. And so why should I risk my life or my fortune for a bunch of perhaps socialists or crazy Georges? And I'm not going to do it. I'll take my chances. Well, you're bringing the whole planet to an end. They say, well, I'm going to die anyway. So you're up against that kind of thinking, and it's pretty powerful. It's pretty powerful, and I'm not sure that you can overcome that. So that we Georges here, in one sense, feel we have a reasonable solution, at least on the income and productivity side. We have no more answers on the pollution side, other than we're sensitive to it. And you have to have both of those solved to have any chance at stabilizing this planet. What's confusing here is we live millions of years without this being a problem. It's only been a problem 200 years because we actually intervened with the planet. It changed its demographics chemically and didn't know what that was going to do, and now we pretty much know, but now our standard of living is based on it, and to reverse it would be put us in poverty before perhaps the planet blew up. So I think it comes down to what the French King Louis said. He kind of knew it was going to blow. His game, there was a lot of pressure in France. He had taxed them to death from fighting wars. There's lots of complaints. Any smart person would have known there were unhappy people. There were scheming people and plotting people. But I'm sure he said, I don't know what to do about it. I can give them more bread, maybe I can take less money. I tell the nobles to lighten up the taxes, they might kill me. The nobles themselves might say, no, I'm not going to give up my stuff. So that nobody can make the move to stop the world and do the right thing. And I think the French king summed it up perfectly in his famous phrase, after me the deluge. Okay? I'll live good. When I go, it blows up, but I'm gone. I'm not worrying about it. So I think countering the after the deluge thinking is the real challenge on planet Earth. There's no question in my mind that we have the means and understanding to change things and make it better for everybody. But again, you know, I see Bill Gates, he's in his 50s, a very wealthy guy. He's running around with this foundation, handing out mosquito nets to Africans. You know, I'm sure he's giving tetanus shots to alligators. I'm sure he's doing all kinds of things like that, which in and of themselves are good. But what he isn't doing is he's not helping Africans or South Americans how to change their country to make it self-sustaining and able to have a meaningful income distribution for everybody. He's not doing that. You know, you come to him with a hangnail, he's right on top of that one. Or Bill Clinton with his foundation. You know, Billy raised $500 million to do good. Okay, thanks. This is the end of session 2. Thanks for watching. We look forward to you joining us in section 3 and 4, and perhaps you might learn something. For sure, Richard Duncan gives a nice, concise explanation of what happened in the 2008 period. So it'll give you something to chew on, because it doesn't change the ultimate intentions of mankind, but that's another story. Thanks. Okay. All right.